in Chapter 6 on credits and special taxes. I want to just kind of start off at the adoption expenses. We kind of finished up with the expenses, but didn't get a chance to really go over some exercises to make it clear on when the deduction is can be taken. When you have more than 1 year of expenses, when do we actually take the deduction? And it depends on if it's domestic adoption or if it is a foreign adoption. So it kind of depends on that as well. So kind of just wanted to look at page 6-11. So turn to 6-11. Basically, you get a credit for your qualified adoption expenses that you pay. We can get a credit for that, and remember, a credit offsets your taxes. And we can exclude from our income, if we have an employer that pays those adoption expenses, we can exclude those from income, those payments made by our employer. The credit is up to, and it changes every year, we're up to $11,650 of a credit this year. And so these were on your PowerPoints, and you may have these in your handout already. So the credit is $11,650, which is a pretty substantial credit. It's going to phase out for high income taxpayers with incomes with AGIs of $174,730 up to $214,730. So it's totally phased out for anybody who has income over $214,730. Okay, so the expenses or the credit is taken in one of a number of years as you go through the process of the adoption. So let's first look at when it is a domestic, so a U.S. multi-year adoption. If it's a U.S. multi-year adoption, then that credit is going to be allowed for tax years that follow the tax year in which it's paid or in the final year of the adoption. So they have an example here on page 611. In connection with the adoption of an eligible U.S. child, and it's not a special needs child, because if you recall, the special needs child, they get a credit of that $11,650 regardless of how much expenses they incur. If they incur $1,000 worth of expenses and it's a special needs child, they get the full $11,650 credit. So let me continue reading the example. In connection with the adoption of an eligible child who is a U.S. citizen and is not a special needs child, a taxpayer pays $6,000 of adoption expenses in 2008. So 2008, $6,000 worth of expenses, and $6,500 of qualifying adoption expenses in 2009. The adoption is not finalized until 2010. So we have expenses in 08 and 09, and they don't mention any expenses in 2010, but that's when the adoption is final. Okay, so the $6,000 worth of expenses that we incurred in 08, they would be deducted in the following year, which is in 09. The 2009 adoption expenses would also be deducted in the following year, which is also the final year, the year that they finalize it in 2010. So the domestic rule is that you can deduct the adoption or take the credit in the year following the expenses were incurred if it's not the final year. So 2008 expenses we took in 09, 2009 expenses we took in 2010. Okay. On the other hand, they give an example. If the adoption was finalized in 2009, then the full $11,650, the limit, would be taken in that year. So we could have taken them all in that year. We wouldn't, if it was finalized in 09, we wouldn't have had to wait to 2010 to take those 09 expenses. We just get to take all of them, the 08 and 09, and then the 09 in the year of the adoption. Now, if it's a multi-year foreign adoption, then the credit or the deduction is going to be allowed in the year in which the adoption is final. If the adoption doesn't become final, then the expenses are not deductible. And we have an example here on 611. In 2008 and 2009, a taxpayer pays $3,000 and $6,000, respectively, of qualified adoption expenses in connection with the adoption of an eligible child who's not a U.S. citizen or resident of the U.S. In 2010, the year the adoption becomes final, the taxpayer pays an additional $3,000 of expenses. So we had $3,000 in 2008, $6,000 in 2009, and $3,000 in 2010 when the adoption becomes final. The full amount of the credit will be taken in 2010 when the year is when it's final, and they only get the $11,650, even though they had $12,000 worth of expenses. Remember, you're limited to $11,650. Now, that credit is not a refundable credit, so it's going to be limited to your tax liability, and then any unused amount can be carried forward. Okay. So at the top of page 612, we just got a few more notes that I will handwrite, and then we will continue with the chapter. When we talked about employer-provided adoption assistance, and so they're telling us we do not have to include that, so therefore we can exclude that amount from your W-2. So we can exclude the amounts paid from our income or the amount of the expenses that your employer may provide. Okay. Under their adoption program. Now, it's still going to be limited to that exclusion. It's still going to be limited to $11,650. And there's a phase out for high income taxpayers of $174,730. It's the same phase out from $214,730. So phases out in between those ranges. Anything over that does not get that amount. And then you want to make sure you're coordinating the credit and exclusion, and that we're not talking about the same expenses. So you want to make sure you have a coordination of credit and the amount of income that you're excluding. And they're not for the same expenses. Okay, and then the expenses that they do allow this are deductible have to be reasonable and necessary. They have to be reasonable and necessary. So reasonable and necessary fees, court costs, attorney fees, and then any other direct expenses you may have. Okay. So that takes care of our adoption. Okay. Next, we want to deal with our, we have some temporary energy credits. There's no notes on those. These we'll just kind of talk about them. There's 3 credits that we want to look at. We want to look at the credit for hybrid vehicle purchases, the credit for energy, providing energy efficient things in your home, and then there's a lifetime 500 life credit for energy savings improvements, and so energy efficient property for your home, and then energy savings improvements to your home. Okay, so let's look at those. We want to start with our hybrid vehicles. There's a credit that you could get for the purchase of hybrid vehicles. Okay, it was based on weight, class, and fuel economy, and it was phased out. Its plans to phase out, and then actually it was phased out when the manufacturer sold 60,000 of hybrid vehicles. Okay, Toyota and Lexus, which of course they're the same, was fully phased out in October of 2007, so more than over a year ago. There's no indication of, I believe Honda has a hybrid, and I want to say someone else, it doesn't come to my name, that has a hybrid. But if you go to the IRS website, remember irs.gov, they'll give you a list of those and the credits, and then if they are out, they'll tell you what models and and you had to have it by the date of purchase, because that date of purchase is going to let you know, look, if I purchased it within that date, then I was in that $60,000 limitation. If I purchased outside that date, then I was not within that limitation, so therefore I'm not going to be able to get the credit. So it was for $60,000. Okay, and so under the new law alert, make a note that beginning in 2009 and this year, they will be offering a credit for the purchase of a plug-in electric drive vehicle. So, and that credit is going to range between $2,500 and $7,500. So keep that in mind, because the hybrid vehicles have phased out because of they've reached their maximum. Next is a $500 lifetime credit for energy savings improvements to your home. This credit was not allowed in 2008, but it is picked up for 2009. So this is for purchases in 2006, 2007, and in 2009. So any purchases you make this year would be eligible for this credit. It's a 10% credit for cost of qualifying property or purchases up to $5,000. So that's your maximum $500 credit, which is 10% of $5,000. Okay, so this is for, it has to be for improvements to the taxpayer's principal residence, new property, meaning what I'm installing is new property, and it has to stay in use for, or be able to be in use for 5 years. And they say a 2-year warranty is enough to suffice that it would be in use or stay in use for 5 years. They give you some examples, and we'll look at a few of them. The cost of installation materials or systems that reduce the heat loss or gain, exterior windows, including skylights and storm windows, exterior doors, and certain metal roofs, seals to limit air infiltration in your home, such as caulking, weather stripping, foam sealants, and storm doors, all are allowed. Now, you can only get a $200 credit for buying and installing energy-saving windows, asphalt roof with appropriate cooling granules, and added 10% category. So that's effective in 2009. Then up to $300 of a tax credit may be qualified for efficient water heaters, heat pumps, and central air conditioners. So energy efficient biomass fuel stoves qualify beginning in 2009. Up to $150 credit for qualified efficient furnaces or boilers, and up to $50 credit may be for an advanced main air circulating fan. So they give you some details there on page 613. They give us an example. John spends $2,000 to certify energy efficient installation for his main home and installs certified energy efficient windows costing $2,000. He spends $3,000 on a new certified energy efficient natural gas boiler for his main home. So for 2006, he can claim a $400 credit. He can get 10% of the $4,000 that he spent. In 2007, he may only claim an additional $100 on that boiler, because you can remember you can only take up to a $500 credit. So once you hit that $500 credit, that's the max that you can take. At the top of page 614, credits for energy efficient property. Energy efficient property, and this is a credit up to $2,000 for 30% of the amount that you paid for qualified solar electric property or qualified solar water heating property. Okay. Now the other credits can't be used to offset alternative minimum tax, which we'll deal with next, but this one can be used to offset alternative minimum tax. So if we look at the top of page 614, in addition to significant credits are allowed for taxpayers who have small wind energy property or qualified fuel cell property to generate electricity for the use in their residence, qualified geothermal heat pump property, which uses ground or groundwater as the thermal energy source to heat or cool a residence. These credits may not be used for the installation of heating swimming pools or hot tubs. So it can only be for the home. So as an example there on page 614, In 2008, May buys 4,000 solar water heating equipment for her second vacation home. The equipment is not used to heat the swimming pool or hot tub. She may claim a credit of $1,200 for 2008. Now notice that one was on her second home. The lifetime credit for energy savings improvements is on your main home. So you can get a credit on this one for the second home. The new law alert on this one. The Emergency Economic Stabilization Act of 2008, which was signed into law just here in October of 2008, contained extensions and expansions of the credits listed. The credits were extended through 2016, and in the case of solar electric property credit, the limit on the cost of the property subject to the credit was moved for 2009 in the future years. So, for example, a taxpayer installing a qualifying 30,000 solar electric system will be allowed a $9,000 credit. Remember, the limit was $2,000, so they removed that limit, so you get 30% of whatever you purchase. The expansion of the solar electric property credit, in particular, is expected to significantly increase the number of systems installed in addition to assisting the solar energy industry. So you can expect huge amounts because you get 30% as a credit for your taxes on those items. Okay, let's look at self-study 6.7 on page 614. We have calculate the energy credit allowed for the following purchases. In A, we got Jeffrey purchases a Toyota Prius in May of 2008. Assume Jeffrey's credit is not limited by the alternative minimum tax. So what would be his credit? Jeffrey would not be able to get a credit because the credit for the Toyota Prius was phased out in October of 2007. They had met their $60,000 limit. So anybody who purchased the Prius after that would not be eligible for the credit. B, Gwen purchases 2,000 of qualified energy efficient insulation and 2,000 of energy efficient windows for her principal residence in 2008. So we're making that energy savings improvement to our home. She made a purchase of 2,000 in 2008. So how much of the credit would be allowed? None would be allowed because remember that particular credit was not allowed for 2008. It's allowed for 2006, 7, and 09. So she would not end up getting any of that. Okay. C, Parker purchases $5,000 of qualified energy efficient installation for the second vacation home in 2008. So once again, that's the lifetime credit for energy savings improvements. The problem with that one is that it was that particular is purchased for the vacation home, so not the main home, so therefore would not get it. D, Betty purchases a solar system to heat her hot tub for $2,000 and a second certified energy efficient solar system to heat her home for $10,000. So she would get a credit of only on the system to heat her home. Remember, you cannot get a credit to systems for a hot tub or swimming pool. So in that particular credit is 30%. She spent $10,000. And so if you take 10,000 times 30%, you would get 2,000, you would get 3,000. But because in 2008 the credit was limited to 2,000, they would only get 2,000. Any years after that, they would get 30% of the credit. So those are the credits that they talk about in Chapter 6. So we've looked at a number of credits before we move to additional tax, special taxes. We looked at child tax credit. We looked at the earned income credit, which is a refundable credit. Child tax is not. Child tax credit, I take that back. A portion of it could be refundable. So we looked at child tax credit. I got a phone call last night regarding the age on that child tax. You know that child tax is $1,000 for the children must be under age 17. And her question was, my child is going to be 17 in 08. And I said, well, they have to be under 17. So, just be aware that credit is going to go away. So, but child tax credit, earned income credit are both refundable credits. Then child independent care credit, which is not a refundable credit. Education tax credits We looked at the Hope credit and the Lifetime Learning credit, which are not refundable credits. Then we looked at the foreign tax credit, which is also not. And then we looked at the adoption credit, which is not a refundable credit either. And then we looked at our energy credits, which are not refundable credits. And so now we want to look at alternative minimum tax. Many, 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 and many more people are falling into what we call alternative minimum tax. They're being subject to the alternative AMT, which is it's often called AMT. They've been subject to the AMT rules. It wasn't the initial intention that a lot of taxpayers are subject to this, but it's just becoming the case. So AMT, alternative minimum tax for individuals. I want to go over the formula with you. And this particular tax is going to be due, as we look at the formula, if AMT is larger than regular tax. Okay? If the AMT is not larger than the regular tax, then you won't have AMT. So as we look at the formula, everybody doesn't necessarily fall into AMT, but if your AMT is larger than regular tax, you will pay the AMT. Okay? So let's look at our formula. We start off with our regular tax. Okay, so we want to start off with our regular taxable income. And then we're going to add or subtract to that AMT tax preference items or adjustments. And on page, let's make a note on page 6-15, they list some of those adjustments and preference items. Okay? And so after we add or subtract those items, we get what we call can't write today, AMTI. Basically, I want to make that. This is AMT taxable income is what that stands for. Okay, so we get our AMTI, which is AMT taxable income. And then we're going to subtract from that our AMT exemption. Okay, and that equals the amount that is subject to AMT. And then we want to multiply that by the AMT tax rate. And then that's going to equal our tentative tax. Tentative minimum tax. Okay, that equals our tentative minimum tax. We subtract from that regular tax, just our regular tax before AMT. And if you end up with a positive number, that is your AMT. If it's a negative number, you have no AMT. So let me give you an example. Let's say we go through the calculations and our tentative minimum tax is $21,000. Okay? Our regular tax was $11,000. So therefore, I would have $10,000 of AMT. I would pay $10,000 of AMT, $11,000 of regular tax. So my total tax paid would be $21,000. On the other end, if my tentative minimum tax was $21,000, but my regular tax was $25,000, then I have no AMT, and I would pay my regular tax. So bottom line, you're going to end up paying the highest tax, be it if your regular tax is higher than your AMT or your tentative minimum tax, you'll pay that. And if your if the tentative minimum tax is higher than your regular tax, you pay the tentative minimum tax. If your regular tax is higher than your tentative minimum tax, then you pay your regular tax. So you're going to pay the higher, basically, of the two is what you're going to pay. Okay, AMT adjustments and preferences, as we as we mentioned, often are just timing differences. You know, maybe they'll allow you straight line depreciation opposed to accelerated depreciation. So it's not that you won't get the full amount of depreciation over the time. It's just a timing differences. So timing differences due to AMT and regular tax calculations. They may have you recalculate it a certain way for AMT purposes, and you take the difference between what your calculation was for regular tax purposes. Okay, preferences are basically special provisions for regular tax that are not allowed for AMT. That are not allowed for AMT. So certain taxes are deductions that you may get for regular tax, but they make you add them back for AMT purposes, meaning you won't be able to get those. Okay. We mentioned an exemption amount for married filing jointly. It's $69,950 for single and head of household. It's $46,200, and for married filing separately, it's $34,975. So those are your exemption amounts. Okay, and they're going to be phased out for high income taxpayers. And then the AMT tax rate is 26% rate on the first $175,000. And then we're going to charge you 28% on amounts over $175,000. That $175,000 number changes if you're married filing separate to $87,500. So those are the AMT tax rates. The AMT formula you do in order to do AMT, it's done on a form. Let me get that form number. Where's my form for AMT? It's on form 6251. Any tax software that you have will calculate AMT for you, and it will go through the calculations, so you won't have to figure that out on your own. It is a pretty complex calculation, so we won't cover it in any more than what we did in the overview, so that you're aware of AMT and you're aware of the possibility of you being having to pay AMT. And like I said, if you're using any of the tax software, it will do the calculation automatically for you. You don't have to ask it, but it will definitely do it for you and show that alternative minimum tax. Okay. The next special tax we want to look at has to do with tax for when we're dealing with unearned income of minor children. If you have a minor child who has income, dividends, interest income, then they have to pay taxes on that. And there's a calculation that we do, and it can either be added into the parent's income, or they can do it separately. So starting on page 6-20, we want to look at unearned income of minor children. And this comes from parents shifting income, be it through gifts to their children, and then or assets or cash or whatever the case may be, making investments. And so revenue, dividends and interest that comes back to the children used to be taxed at the children's rate, a lower rate. So it was a way to shift income. So it was a way to shift income to children would be in a lower tax bracket. Okay. That's why this has come up, because of that shifting. Okay. So this is going to apply to children who are 18 or younger at the end of the year, Okay, so children who are 18 or younger at the end of the year. Okay, or students ages 19 to 23. Ages 19 to 23. Okay, so that's who we're looking at, children who fall in that category. Also, they have to have at least one living parent. And they have to have some net unearned income. Some net unearned income. So let's look at a couple of things before we go through the calculations. They talk about the Tax Reform Act of 1986 contained provisions that limit the benefit of that shifting income to certain dependent children. Okay, the net unearned income for dependent children may now be taxed at their parents' rates, and this parental tax, as they said, applies to children who are 18 or younger, and at the end of the year, are students who are 19 to 23. Now, I read that only to look at the new tax law. Beginning in 2008, the kiddie tax, which is what we're referring to, is expanded to catch even more children and adult students in its net. In 2007, the kiddie tax applied to children under age 18. And beginning in 2008, the rules applied to children who are 18 years or older and students who are students. So it expanded that instead of just being under 18. It caught those students who were in college. Wages earned by these children would be taxed at the child's lower tax rate, but investment income would be taxed at the parent's tax rate. The new rules are meant to block parents from taking advantage of the child's lower tax rate through gifts of investments to their children. The law change in 2008 is connected to the reduction in the dividend and capital gains tax bracket. Keep in mind there was an adjustment for that to where it's 10 and 15 and even 0% in some. So them realizing that those rates were going to be lower, realized that maybe we might expand the number of children that it involves so that we can catch that. Okay, let's look at the computation. Let's look at the computation related to this. Okay, we want to start off with the unearned income. Start off with the unearned income. And then less the greater of $900, which is the child standard deduction. I just put child standard deduction there. Or 2, the allowable itemized deductions, if the child has some. Okay, the ones that are directly related to the unearned income, which would be investment expenses. Okay, so whatever that ends up being, less the greater of either the 900 or the allowable expenses. Okay, and then we're going to subtract from that less the statutory amount deduction. And then that's going to equal their net unearned income. That equals their net unearned income. Okay. So now what we want to do is look at what's happening on our parents' return. We want to look at what's happening on our parents' return. So then start off with AGI. Okay, so we want to start with their AGI, and then we're eventually going to look at what's happening with their parents' tax. But we want to start out with the AGI less their standard deduction. Remember, it's $900. And then less their personal exemption, if they have one. And that's going to equal their taxable income. Okay, and then we want to subtract from that their net unearned income. Number we just figured there. Okay, and then that's going to give us the regular. Then we want to calculate from that. Okay, we'll get our taxable. And then we're going to get regular tax. Okay. And we're going to look at the parent tax. And that's going to give us our total tax. Give us our total tax. Okay, so let's just kind of stop there and look at an example, and then we will go on there, because I've written a lot of calculations, but it's always just helpful to throw the numbers and put some meaning to it. Dana and Mark have 2 children, Alex and Nathan, 1 and 7. Alex received $3,000 of interest income, and Nathan received $1,900 of interest income. So there's your unearned income. Alex and Nathan did not pay any investment expenses for the year. Dana and Mark have taxable income for the year of $45,050, so that's the parents' taxable income. Alex and Nathan's 2008 income tax is calculated as follows. We want to start with their net unearned income, which was $3,000, and then minus their standard deduction of $900, and then minus their, they said the standard deduction are investment expenses, which they didn't have any, so we're going to take the $900 standard deduction. And then minus their statutory deduction. And so then they get their net unearned income. Okay. So if we were, I want to calculate that out for you. Okay. So that you can see it. And even though it's in your book, it just helps. We start off with our unearned income. And it's the $3,000. Minus, remember, the lesser of either the standard deduction or $900. Okay, and then minus our statutory deduction of $900, and so we get net unearned income of $1,200, and this was for Alex. And Nathan was similar in that he had $1,900 of unearned income. Minus, they didn't have any expenses, so minus the $900, and then it's minus his $900 statutory. So he ends up with $100 of NUI. Okay, so remember, we're going to look at the parents, and so we start off with their calculate the total parent tax. We want to start with the parents' taxable income. They told us that their taxable income was $45,050, and then we want to add to that the kids' tax of $1,300. Net unearned income. I'm sorry, not their tax. We want to add the kids' net unearned income, and so we get $46,350. And so now we want to calculate the tax on the revised income. So basically the new tax on our new $46,350, and we get $6,154. The tax on the old number was $5,959, and that was taxed based on the $45,050. So basically that lets us know that the parent tax on the kids' income is $195 because their tax increased by $195 once we add the kids in there. Okay, so then we have Alex, and Alex's parent tax that he has to pay is going to be, he had $1,200 worth of income divided by the full amount of $1,300 total between the two, and we want to multiply it times the tax. So his portion of the tax is going to be $180. Nathan's parent tax, or his portion of the tax, divided by the $1,300 times the $195, is going to be $15. And so that gets you back to the $195. So his portion of the tax is going to be $180, and his portion of the tax is going to be $15. And so let's go back to our calculation. And the problem always helped. Remember, we started with the parents' AGI. I keep saying that, but I haven't got to that point yet. Hold on, let me finish the problem. I'm sorry, I'm not there yet. So Alex's portion is $180, and Nathan's portion is $15. So to calculate the total tax, okay, for Alex, his regular tax would be 10%. Okay, and this is given. It's 10% on the 900. Okay, so it would be 90 plus his parent tax of 180. And then Nathan would be the same 10% on 900, or 90, and 15. Okay, so his tax would be 270, and his would be 105 is what he would pay. Okay, so we have Alex and Nathan. They must do a Form 8615, the tax for children, and have investment income of more than $1,800, in which they do for their individual amounts. Okay, so now let's go back to and clear up my calculations. Okay, we were okay with this piece of it, where we came and we got the kids' net unearned income. Okay, net unearned income. So what you have to do is you have to actually, and I don't really like this, we really need to start here with the kids' tax, with the parents' taxable income. Let's do that. Okay, we want to start with the parents' taxable income, and let's ignore this. So we want to start here with the parents' taxable income, and then actually we want to add, and I don't know what calculation I'm doing here. We want to add what I was doing over here. We want to add the kids' net unearned income to that, and then that gives us our new taxable income for the parent. And this is the new taxable income for the parent. And so then what you want to do is you want to get new tax. Okay? You want to say, what is my new tax for the parent? And then you want to take the parent's old tax, and the difference is going to represent the parent tax. Okay? The difference is going to represent the parent tax. Okay, and then that's what's going to go to the child's return. Okay, so let me write that again in a little more clarity, because I totally messed up that. I was using an old note sheet, and so it's totally off. And so after you calculate the kids' net unearned income, once you get that, okay, you want to start with the parents' taxable income. Okay, and then we want to add to that the kids' net unearned income. We want to add to that the kids' net earned income. And then that gets us a new taxable or revised income. And I like to call that my new taxable income. And then from that, I want to calculate new tax on this new taxable income. Okay? And then I'm going to look at the old tax off my old income for the parent. And I want to take the new tax minus the old tax. And that difference, which is going to represent my increase in tax, is going to be the parental tax. And that particular tax is going to go to the child's return. Okay? And so that's basically the way you want to do that. So, didn't mean to confuse you. And because we're out of time and I'm concerned about whether I've confused you on the calculation, in the beginning of our next session, I'll do a problem. And actually, if you want to go ahead and work that problem, it's at the end of the chapter. Let's pick one. Let's look at, we're going to do problem 28 and 29, okay? We're going to do problem 28 and 29. We're going to look at those. So if you want to go ahead and work on those at the beginning of our next session, we'll go ahead and do those. And we just have a little bit left in this chapter. And then in our next session is our last session. So we will wrap up. I have a few things I want to cover in chapter 9. If time permits, we may do a tax return problem. But this is tax credits, chapter 6. Have a few things I want to cover in chapter 9, and that should finishes up for basic income tax. That's it. Work those problems, and we'll do them at the beginning of the next session.